welcome. You are watching Your Money Matters. I am Mahima Vajrajani. Today's topic on Your Money Matters is Contra Funds. Now, these are the kind of funds, equity mutual funds in fact, that employ into a contrarian investment strategy. That means that they'll invest in stocks that are currently out of favor of markets or are having negative sentiments. Now, this is just a gist of, what the entire, just a tip of iceberg of what, the entire theme is. And to take us through this entire theme, what contra funds are, how do you deploy your funds in one of these funds, we are joined by Rishabh Desai, founder of Rupee with Rishabh Investment Services, joining us now. Rishabh, hi, very good evening to you, and always a pleasure speaking with you. Before I go on to the details of this particular theme of funds, I would like you to explain audience in simple language as to what contra funds are.
Hi, Mahima. First of all, thanks so much for having me on the show. As you correctly mentioned, a contra investing strategy does the exact opposite what the market does, right? So when people are actually selling in the market, the contra investor actually goes in the market to buy. And when people are actually buying in the market and uplifting the market, the contra investor either just stays put or sells in the market. It does exactly the opposite. Contra investor or contra strategy overall invests in underperforming stocks or sectors or segments in the market, which are given negative returns. So this gives a good margin of safety, and it gives a good upside opportunity for investors over the period of time when the market or that particular segment actually enters into the recovery phase and the bull run, Mahima.
Interesting. Rishabh, there's always a confusion when it comes to contra funds and value funds as well. Just want to get your sense of the difference between, I'm sure there's a thin line difference between contra fund and something like a value fund. What is that, and how is one supposed to, identify the difference between the two?
Mahima, I'm really glad you asked this question to me, because a lot of investors out there get really confused, because overall, if you go to see contra and value as a category is one, amongst many other categories out there. And, AMCs are allowed to keep either a value fund or a contra fund in their basket. So they actually cannot keep both contra and value together. So see, as I mentioned earlier, that a contra fund actually invests in underperforming segments or stocks or sectors in the market. On the other side, a value picker or a value product, invest in undervalued sectors and stocks in the market. Now, what I mean by undervalue, say, if a particular stock is priced, say, 100 rupees, right, and if the fund manager feels that this is actually not its true potential price, and its true potential price is somewhere, say, probably say 1,000 or 1,500 or 2,000, the value picker will invest in such stocks which are undervalued and will wait for the true value to unlock of that particular stock. Now, on the other hand, contra fund or a contra fund manager will invest in underperforming stocks or sectors which have given negative returns over a period of time, which have unfortunately not done well. But it's very important for investors to understand out there that a contra product will be volatile, but may not be as cyclical as value, because in a value strategy, it will take a long time, or it may take a long time for its true price to unlock. So a value fund will be more volatile plus cyclical, but a contra fund may be volatile but not as cyclical as value funds out there.
Interesting. So just to sum that up, value investors will go ahead and invest in value funds where there are undervalued stocks or sectors. And if it is a contra fund, the idea is to invest in underperforming stocks or sectors. Rishabh, but out of the two, if you were to choose one fund, because when we talk about investing in a contra fund or a value fund, it's always a part of your total portfolio. I wanted your sense whether if one person wants to go ahead and choose and invest in one of these funds, would you choose a contra fund or a value fund?
I think, see, having both funds in one's bucket would be best. See, this is what I tell to all of my clients out there. See, diversification is the key. Ultimately, every style, whether it is growth, momentum, value, contra, will have cycles of outperformance and underperformance, Mahima, right? So I think, to minimize underperformance at the overall portfolio level, I think it's very important to diversify across all different sides, whether it is growth, momentum, value, and contra. Now, investors should keep in mind that contra and value as a segment is high risk, high return segment, right? Now, it may not suit every investor out there. Okay. If someone is able to stomach volatility and cyclicality, then having both contra and value products in one's portfolio should do the job. So overall, I feel if someone has a 10-year plus kind of a time horizon, then investing across all four styles, which is growth, momentum, value, and contra, is something what I would recommend.
Okay. And then, considering that, what percentage of your total portfolio should be ideally be allocated to contra and value funds?
Individually, I think not more than 20 to 25% in each. So now, if someone has all four styles, then 25% allocation towards momentum growth and 25% allocation towards value and contra. So I'm saying 25% each. So you can put value and contra in one bucket, say 50% allocation, and another 50% allocation can be given to momentum and growth. So I mean, again, I'm being very clear that uh, contra and value will be high risk, high return. It may not suit every investor out there. If someone cannot stomach volatility, then I think going for blended strategy, flexi cap, multi cap, or focus funds, I think that should be someone's priority to go for blended strategy, because the fund manager has the liberty to choose between different styles, different market caps in a blended kind of strategy. But if someone is looking for really long-term alpha generation, I think then going into individual strategies with 20-25% allocation towards each of the strategy is something what I would recommend.
All right. So if you're a risk taker, you can go ahead and further allocate more funds in value as well as contra funds. Rishabh, there are around 3 contra funds in the market today. Give us some details about those 3 contra funds. Overall, what is the sector allocation like? Who is managing it? What are the returns looking like? Give us some details with regards to that.
Okay, Mahima, so there are three contra funds, as you mentioned. One is Invesco India Contra, second is Kotak Contra Fund, and third is SBI Contra Fund. Now, if you talk about the returns, fortunately, all of these three funds have done phenomenally well. Okay, over the past 2, 3, 5, and 10 year from a point-to-point basis, all of these three funds have outperformed the Nifty 500 TRI index. Okay, from 2 to say probably 5 years, they have delivered more than 20% plus CAGR returns, and over the 10-year period, they have generated more than 15% CAGR returns. Now, both all of these three funds have delivered in line with value funds. So the value as a category and contra as the category, right? Both of them have delivered somewhere very much similar in line returns. So the value as a category at a category average on a say 10-year returns basis, they have delivered around 14% CAGR returns, and the contra funds have delivered around 15% CAGR returns. So it's more or less in line with the value funds. Now, as I mentioned earlier, that yes, there have been pockets of outperformance and underperformance. I feel that contra funds would do really well during recovery phases, and most importantly during bull phases in the equity markets.
Right. Just to follow up on that, generally when we see a normal mutual fund which does not, adopt a contrarian approach, we do take into picture the up market capture ratio and the down market capture ratio. This is just, I was wondering, in such circumstances, will that reverse, when it comes to the up market capture ratio and down market capture ratio?
See, all of these statistics may not change from time to time. Okay.
Yeah.
So you really need to understand that, while betting on a fund, I think it's very important to bet on the fund manager and its team and the overall AMC. That's what I truly believe in. Okay. As long as the fund is able to deliver consistency in outperformance on a 5-year, 7-year, and a 10-year daily rolling basis, then I think that's the fund where I would want to go into. Okay. I don't necessarily chase, the top performance. Now, what I mean by top performance is like the top 1, 2, or 3 performance out there, because we have historically seen that, the top performance have kept on changing from time to time, especially on a 3 to 5 year returns basis. So I feel chasing consistent outperformance is something what investors should look out there. But to put it in perspective, all of these ratios are good parameters to select a fund, but it should be at a little bit on the bottom of the priority list. I think the most important thing is to bet on the fund manager and how well the fund has been able to perform consistently over the past 5, 7, and 10 years.
Okay, Rishabh, the three funds that you talked about, they're all unique portfolio, but the overlap is anywhere between that 19 to 30% mark. Any, particular starking difference that you see in the three contra funds that you observe, and why does that stand out for you?
As you correctly mentioned, all of these three funds have unique portfolios and have 19 to 30% portfolio overlap. So, overall, even though the strategy is same, they are not investing in the same stocks, although they might be investing in more or less the same sectors, right? So I think I like all three funds. Particularly, I'm more inclined towards Invesco India Contra. That's my favorite pick out of the three. Again, to put it very simply, that all three funds have generated outstanding outperformance and outstanding returns. But out of the three, I really like Invesco India Contra. Now, if you look at the underlying portfolio of all of these three funds, I mean, the portfolio churn also has been quite limited. I mean, the portfolio churn, to be very specific, the portfolio turnover ratio has been in the range of say 17 to 56%. Now, this clearly indicates that that they are going ahead with buy and hold strategy. They are not, at least at this point of time, they are not very aggressive in terms of their churn. At this point of time, they are following a buy and hold strategy. Now, why I feel, Mahima, that contra funds, all of these three contra funds are true to their label is for the following reasons, Mahima. See, at this point of time, the overall underlying portfolio at the category average level is around 30% of these funds are inclined towards large cap banking and financial stocks. This is number one. Number two, the overall market capitalization at the category average of all of these three contra funds is minimum 50% into large cap, and the rest is divided into mid and small caps. Okay. Now, why I feel that it's true to its label is because, see, large cap as a segment has underperformed over the past 3 to 5 years versus mid and small cap. So, having at least 50% allocation in these funds towards large caps means that the contra funds are really looking for upside opportunity in the large cap segment. Second is that they have high allocation towards banking and financial stocks. And if you see the valuations of the banking and financial sector, it's quite reasonable at this point of time compared to other sectors in the market. So I feel that the contra fund managers are also looking for good upside opportunity in the banking and financial sector. And most importantly, we did see a good price correction in the mid and small cap space around 3 months back. So I think having a good blend of all of these factors, having a decent allocation towards large caps, having a decent allocation towards banking and financial sector, and having decent allocation towards mid and small cap, all of these factors make me feel that over the next few years, contra funds may really do well in terms of returns, Mahima.
Interesting. That's an interesting take. Considering the expense ratio in all of these three counters, how would you rate from 1 to 3 for all of these funds?
My expense ratio will again keep on changing from time to time depending on the AUM. So if the fund is having a larger AUM, of course the expense ratio would be lower. Now, I tell this to my clients that don't look at expense ratio. I mean, expense ratio is indeed important. There is no doubt in it, but it should be actually at the very, very bottom of your choosing list. Okay. See, as long as the fund is outperforming the benchmark, that is something what you need to be concerned about. As long as the fund is giving you outperforming returns, it really doesn't matter whether the fund is having a lower expense ratio or a medium expense ratio or a higher expense ratio. I mean, see, if you're choosing between regular and direct, I mean, of course, regular will have a little bit of an higher expense ratio because you are paying the distributors the commission. And in the direct plans, of course, you're doing direct and you're not paying the distributors. But I truly feel outperformance is something what an investor should look at, and the expense ratio is something that should be at the bottom of your priority list.
Rishabh, this contrarian strategy is something that not everybody understands. Though we are trying to break it down in simple terms, for a person who does not understand the markets at all, but still wants to go ahead and invest in, would be scared of investing in something like this because the person doesn't understand. What would your message be like to that person? Because while you're saying, there are a lot of mutual funds out there which are, not contrarian to, their theory, but they've not been able to beat their own index, right? For example, we've constantly talked about the defense fund, the HDFC defense fund, where, it's not been able to beat the index at all. What would your advice be to these people?
See, actually, you don't really need to have a contra fund to be a contra investor. There is a difference, Mahima. I truly feel contra strategy is an evergreen strategy, and contra strategy gives the investor a good margin of safety to make money and make I feel a superior double digit risk adjusted return over a long period of time. Now this is the reason why. See, if you have created a well diversified portfolio between large cap, mid cap, small cap, right? You just need to look at which segment is not doing well. Historically, we have seen, markets have fallen anywhere between 10 to 20% on a year-on-year basis. Okay. So if a particular, as long as you're invested in quality funds, as long as the funds are backed by good managers and the AMC team, you just need to look at how much the mutual fund or the particular segment has fallen. If a particular mutual fund or a particular segment has fallen anywhere between say 10 to 20%, I think that should be an accumulation phase, or the accumulation should start for investors in those particular mutual funds or segments. So I think you really don't need. You can actually be a contra investor within the contra strategy itself. But you just need to keep in mind, see, it's very difficult to predict the market. There is again a difference between predicting market cycles and timing markets, right? You can still time the markets, but you cannot predict. Predicting means like when will the markets fall or when will the markets rise? I mean that's a very big question mark to answer. But will the markets fall? Answer is a definitely yes. Will the markets rise? Definitely yes. So when the markets or your products or whichever segments you're invested in, it falls, say anywhere between 10 to 20%, I think that is the right time to be a contra investor and start accumulating, which gives you a very good margin of safety. And I feel with this kind of margin of safety, one can really expect a superior double digit risk adjusted return over the longer period of time.
Okay, so that according to you should be timed investing in contra funds?
See, if you're following a SIP methodology, then timing is not necessary. Okay. But if you're going through lump sum, then of course, I feel that having one eye on the valuations is very important, because you don't want to enter in a particular product at the wrong time. Because see, when an investor is entering in the equity markets, he or she is by default expecting high returns, Mahima, right? So I think one eye needs to be given onto the valuations, even in the contra as a category.
And would you recommend a SIP when it comes to contra fund, or would you prefer a lump sum?
Oh, absolutely. Contra funds will behave just like a flexi cap fund. So, I think both SIP and lump sum methodology would work great.
Okay, interesting. And in terms of an investor who is investing in a contra fund, what would be the kind of checklist that he or she should have before going ahead or selecting a particular fund?
See, first of all, there are just three contra funds, Mahima, right?
Correct.
So the most important, thing what investors should keep in mind, that they should be a high risk investor. Okay, if they don't understand this kind of a category, right, then I think it's not worth for an investor to fall into the contra or the value as a category or funds. I think just go with blended strategies in the flexi cap category. I think they should be very well sorted. But I think going into contra and value will require some expert advice, and I think just understanding how the overall category performs, that keeping patience, it will take time, and just understanding the cycles. I think that is something very important what investors should keep in mind.
And Rishabh, correct me if I'm wrong here. Is standard deviation and beta also the two things that you're supposed to see in a contra fund? If yes, what should be the metrics be?
I think standard deviation and beta is something not I wouldn't give too much of attention because as I mentioned earlier, that contra funds will be volatile. So one needs to be prepared for immense volatility in the contra fund. Now, see, it also depends on how the contra fund is positioned. If the contra fund is positioned and is tilted heavily towards mid and small caps, of course, it's going to be very high volatile compared to the average. But if the contra fund is tilted towards large cap, then there might not be as much as volatility as one would expect. I mean, a standard deviation is a very good metrics to understand volatility, but one should just keep in mind simply that contra funds and value funds will be highly volatile and cyclical.
Interesting. And how would you recommend an investor to invest in a contra fund considering timelines into picture? Would you recommend this to be, in a long-term portfolio, but, there's somebody who's looking from a shorter-term perspective? How would that dynamics play out?
Mahima, this is a great question. I think anyone who's investing in the equity markets, okay, whether in large cap, mid cap, small cap, whichever category, should have a minimum time horizon of 5 years. Now, if someone is an SIP investor, then I strongly recommend a minimum time horizon of say anywhere between 7 to 10 years. But for a lump sum investors who's entering in the equity markets today should have a minimum time horizon of at least 5 years. So I think 5 years is something what I would standardize in terms of time horizon. But again, if one times well, then of course one can expect superior returns even in the short term. Now, what I mean by short term is probably say 3 years or so, but at least keep a time horizon of minimum of 5 years before entering into any equity products.
Interesting. One last question for you, Rishabh. Somebody who's, actively investing in contra funds, should they be aware of the economic factors going on? Let's say your interest rate cycles, your inflation, etc.
I think let the fund manager do its job. I mean, this is what I would suggest.
Okay.
Right? I mean, of course, these are the economic condition gives a very good perspective on how the markets would behave presently and how the markets would turn out to be in the next 2 3 years or so. But I think there is ample of money to be made in all market cycles, Mahima. So I feel let the fund manager do its job. Your job is to create a well diversified portfolio and just stay put for the long term. Otherwise, just let the fund manager do its job.
Okay. Just one more last question. Benchmark awareness. How important is that when you're going ahead and investing in a contra fund? Because you've said that all of these three funds have been able to beat the benchmark so far. Because, one needs to try to understand as to what the benchmark is exactly. What should that awareness be like?
No, absolutely. Investors should be absolutely aware because if investors are investing in either a direct plan or a regular plan, see they are in active participation, Mahima. Investors are paying an additional fee to the fund manager for additional returns over and above benchmark. Now, see, short to medium term underperformance is very normal. Now, what I mean to say short to medium term is say anywhere between say 3 to 7 years. Now, why I'm saying 7 years is because contra and value funds can be little volatile and may underperform over a 7 year period as well. But if I look at on a 10 year rolling basis, if a contra fund is underperforming heavily on a 10 year rolling basis, I think the fund does not deserve a spot in one's portfolio. Now, the returns which I just mentioned were point to point returns. All three funds have done phenomenally well. So I don't see any reason to worry, at least at this point of time. But yes, one eye needs to be given to the benchmark of how the funds are performing over and above benchmark. So I think Nifty 500 is a very standard benchmark which consists of say 70% large cap, 20-25% mid cap, and say around 10-15% small cap. So as long as the funds are outperforming the Nifty 500 TRI index, I really don't see any worry.
All right, Rishabh, thank you so much. It was a very insightful conversation. In fact, I learned a lot from this conversation, and I hope viewers have also learned a lot. And thank you so much for taking out the time and speaking with us at NDTV Profit.
Always a pleasure, Mahima. Thank you so much.